The commodity markets just delivered something rare and unsettling. Copper, gold, and silver, assets that spent months climbing to record highs or multi-year peaks, have suddenly reversed with unusual violence. These are not minor corrections. These are sharp, coordinated drops across metals that typically signal different things. Industrial demand on one hand, monetary fear on the other. Yet here they are moving in tandem, falling hard after what looked like unstoppable rallies. For anyone watching closely, this isn't just market noise. This is a structural message, and it's worth understanding what that message actually says about the state of the global economy as we move deeper into 2026. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. Let's start with what just happened. Copper, often called Dr. Copper for its diagnostic power in reading economic health, hit multi-year highs in recent weeks on optimism around infrastructure spending, electrification, and Chinese stimulus hopes. Gold touched record territory above $2,700 per ounce, driven by central bank buying, geopolitical tension, and persistent inflation fears. Silver, always the volatile younger sibling, rode both narratives, the industrial story and the monetary hedge story, climbing alongside them. Then, in a matter of days, all three plunged. Copper dropped over 8% from its peak. Gold fell back sharply, erasing weeks of gains. Silver, true to form, fell even harder. The swings were wild, abrupt, and synchronized in a way that immediately triggered questions about liquidity, about forced selling, about whether this was just profit-taking or something more fundamental breaking underneath. The scale of these moves matters because commodities don't usually behave this way without reason. They are real assets, anchored to physical supply and demand, to mine output and factory orders, to central bank vaults and jewelry demand. When they all move together and violently, it suggests a common force, and that force is almost always one of two things: a sudden shift in the perception of global growth, or a sudden shift in the availability of money to hold these positions. Right now, both are in play. The growth story that lifted copper is colliding with the reality that Chinese economic data remains weak, that European industrial output is contracting, that American manufacturing surveys are softening despite fiscal promises. The monetary story that lifted gold is colliding with the reality that liquidity is tightening, that margin calls are rising, that speculative positions built during months of easy conditions are now being unwound under pressure. This is not the first time we've seen this pattern. In fact, it's a pattern that repeats with eerie consistency at inflection points in the economic cycle, and every time it does, it precedes something larger. The commodity complex is a leading indicator, not of what's happening today, but of what's coming in the next 6 to 12 months. It's telling us that the assumptions built into prices, growth assumptions, liquidity assumptions, policy assumptions, are now being tested and found wanting. The market is pricing out optimism and pricing in reality, and reality, as it turns out, is significantly less accommodating than the narrative suggested. History gives us a map here. In 2008, commodities peaked in the summer. Crude oil hit $147 a barrel in July. Copper was riding high, gold was climbing. And then everything collapsed together in the fall as the financial system seized up. The commodity crash was the canary. It told you that something was breaking in the real economy and in the financial plumbing simultaneously. In 2011, silver spiked to nearly $50 an ounce in April. Copper was at record highs. Gold was climbing toward its then record, and then the entire complex rolled over violently as Europe's debt crisis intensified and China started tightening. The message was the same. The liquidity that fueled the rally was evaporating, and the growth story that justified it was cracking. In late 2015 into early 2016, commodities crashed again. Copper plunged, oil went below $30. The entire space was in freefall, and it signaled a global slowdown that central banks had to frantically counter with more stimulus. Each time, the wild swings in commodities were not the story themselves. They were the symptom of deeper structural stress. Stress in the financial system, stress in the real economy, stress in the policy environment that had been papered over until it couldn't be anymore. What makes the current situation particularly concerning is that this reversal is happening after central banks have already exhausted much of their conventional toolkit, after fiscal authorities have already run deficits at levels previously reserved for wartime or deep recession, and after speculative positioning in commodity markets reached extremes not seen in over a decade. The rally into late 2025 and early 2026 was built on several pillars. Chinese stimulus expectations, hopes that Beijing would finally deploy the fiscal bazooka everyone kept waiting for. American infrastructure optimism, the idea that reshoring and electrification would drive sustained demand for industrial metals. Monetary hedging, the belief that inflation wasn't done, that central banks would have to stay accommodative, that fiat currencies were structurally weakening. And speculative momentum, the simple reality that as prices rose, more money chased the trend, leverage increased, and positioning became crowded. Now, each of those pillars is under stress. China's latest data releases show property markets still contracting, local government debt problems worsening, and consumer confidence remaining depressed despite policy announcements. The stimulus everyone expected turned out to be more targeted, more cautious, less overwhelming than the market had priced in. American infrastructure spending, while real, is being slowed by permitting delays, by state and local budget constraints, by the reality that fiscal space is tightening as interest costs on the national debt now exceed defense spending. The Federal Reserve, after pausing rate cuts, is signaling that it won't ease further unless the economy deteriorates meaningfully, which means the liquidity spigot isn't opening wider anytime soon. And speculative positioning, built up over months of one-way price action, is now being violently unwound as margin calls hit, as stop losses trigger, as the easy money that financed these positions becomes harder to roll over. This is where the synchronization becomes telling. When copper falls, you might say that's industrial demand weakening. When gold falls, you might say that's real rates rising or speculative excess being cleaned out. But when copper, gold, and silver all fall together sharply, that's something else. That's a liquidity event. That's forced selling. That's the market telling you that whatever was funding these positions, whether it's hedge fund leverage, whether it's retail speculation through ETFs, whether it's shadow banking flows in emerging markets, is now being withdrawn or cut off. Liquidity-driven rallies always end the same way, abruptly, violently, and with everyone trying to exit through the same door at once. Most people watching commodity markets assume the swings reflect supply and demand fundamentals, mine strikes, weather disruptions, inventory draws, production cuts. And fundamentals do matter over the medium to long term, but in the short term, especially after extended rallies, price action is dominated by positioning, by leverage, by who owns what and how they're financed. When speculative length gets extreme, when futures open interest is at multi-year highs, when ETF inflows have been relentless for months, the market becomes fragile. It doesn't take much to trigger a reversal, a weaker than expected data point, a central bank comment, a technical breakdown, and once it starts, the selling feeds on itself. Long positions get stopped out, which pushes prices lower, which triggers more stops, which forces more selling, and the cycle accelerates until positioning is cleaned out and prices find a new equilibrium, usually much lower than where the rally peaked. What's particularly dangerous now is that this commodity correction is happening in an environment where other risk assets are also showing strain. Equity markets have been volatile, with technology stocks swinging wildly, with breadth deteriorating, with defensive sectors starting to outperform. Credit spreads have been widening, not dramatically yet, but persistently, especially in high yield and in certain pockets of commercial real estate and regional bank exposure. The dollar has been strengthening despite falling real rates, a classic sign of stress. When the dollar rallies not because of American economic strength, but because global liquidity is contracting and everyone is scrambling for the reserve currency. These are all symptoms of the same disease, the disease of too much leverage, too much speculation, too much optimism built on too little fundamental improvement, now colliding with the reality that the easy part of the cycle is over. The mechanism through which this accelerates is well understood but often ignored until it's too late. Commodity markets are deeply interconnected with the broader financial system through derivatives, through margin lending, through structured products, through the balance sheets of banks and trading firms that facilitate these markets. When prices move violently, margin requirements increase, forcing traders to either post more collateral or reduce positions. If they can't post collateral, they have to sell, not just commodities but other assets too, whatever is liquid, whatever can be sold quickly to meet the margin call. This creates spillover effects. A commodity sell-off triggers equity selling, which triggers bond selling, which triggers currency volatility. And suddenly you have a multi-asset deleveraging event that central banks struggle to contain because it's not happening in one market. It's happening everywhere at once. We've seen this script before, in 1998 when long-term capital management collapsed and nearly took the global financial system with it, not because LTCM was in every market, but because the forced liquidation of their positions created cascading margin calls across global markets. We saw it in 2008 when the collapse of commodity prices coincided with the collapse of structured credit products and the freezing of money markets. We saw echoes of it in March 2020 when the pandemic triggered simultaneous selling across stocks, bonds, commodities, and currencies, forcing the Fed to intervene with unprecedented scale and speed. The pattern is always the same: a period of calm and rising prices, increasing leverage and speculative positioning, a trigger event that starts the unwinding, forced selling that accelerates the move, spillover into other markets, and eventually either a policy response that stabilizes things or a full-blown crisis that forces systemic restructuring. The human impact of commodity price volatility is often underestimated by those watching from financial centers. When copper crashes, it doesn't just hurt hedge funds, it signals collapsing demand from construction, from manufacturing, from the real economy where people work and earn. When gold and silver plunge after rallying on fear, it tells you that the hedges people bought, the insurance they purchased against currency debasement and systemic risk, are being sold not because the risks disappeared, but because they need the cash now, because liquidity is more valuable than protection. And when all three move together violently, it tells you that global trade is slowing, that financing is tightening, that the inputs to production and the stores of wealth are both under pressure simultaneously, which is a recipe for economic contraction, for job losses, for the kind of broad-based slowdown that policymakers struggle to counter once it gains momentum. The common objection to this analysis is that volatility is normal, that markets correct, that prices go up and down, and that calling every sell-off a crisis is alarmist. And that objection has merit in normal times. But these are not normal times. The level of debt in the global system, public and private combined, is higher than it has ever been in peacetime history. The amount of leverage in financial markets, measured by margin debt, by derivatives exposure, by the size of hedge fund gross positions, is at or near record levels. The concentration of speculative positioning in certain assets, including commodities, including technology stocks, including crypto, is extreme by any historical standard. And the policy space available to central banks and governments to respond to a crisis is more limited than it was in 2008, because rates are still relatively low, because balance sheets are still bloated, because fiscal deficits are already unsustainable. When you combine record leverage with limited policy space, normal corrections become dangerous, because there's less capacity to stop the spiral once it starts. What makes this moment structurally important is that we are at a transition point in the global economic cycle. The post-pandemic recovery, fueled by unprecedented fiscal and monetary stimulus, is exhausted. The inflation surge, which drove commodity prices higher and forced central banks to tighten, is moderating but not disappearing. The geopolitical fragmentation, which is reshaping supply chains and trade flows, is accelerating, creating uncertainty that markets hate. And the debt burdens, accumulated over 15 years of low rates and easy money, are now colliding with higher rates and tighter financial conditions, creating stress in sovereign balance sheets, in corporate refinancing, in household budgets. Commodities sit at the intersection of all these forces. They are inputs to production, hedges against inflation, stores of value, and speculative vehicles. When they start swinging wildly, it's because the forces acting on them, growth expectations, monetary policy, liquidity conditions, geopolitical risk, are all in flux, all uncertain, all pointing in different directions at once. The forward-looking question is not whether commodity prices will stabilize. They always do eventually. But whether the stabilization happens at lower levels after more damage is done, or whether policy intervention arrests the decline before it cascades into something worse. The historical pattern suggests that once commodity markets enter this kind of volatility regime, once the swings become wild and unpredictable, it takes time and often takes a crisis to flush out the excess, to reset positioning, to restore equilibrium. The 1997 Asian financial crisis took months to unfold after initial commodity weakness. The 2008 collapse took over a year from the first cracks to the full systemic event. The 2015 to 2016 commodity rout required Chinese stimulus and Federal Reserve patience to reverse. Each time, the initial volatility was a warning, and each time, the warning was largely ignored until it was too late to prevent significant economic and financial damage. Right now, as we move through the opening months of 2026, the commodity complex is flashing that same warning. Copper, gold, and silver plunging together after record highs is not a random fluctuation. It is a structural signal that the assumptions underpinning recent price action, assumptions about growth, about liquidity, about policy support, are being tested and are failing that test. The crash risk is not hypothetical. It is embedded in the positioning, in the leverage, in the fragility of a system that has been running on fumes and optimism for longer than fundamentals justify. Whether this evolves into a contained correction or a broader crisis depends on variables we cannot control. How quickly positioning unwinds, how much collateral damage occurs in the process, how policymakers respond, whether other markets remain stable or join the sell-off. But the direction is clear. The cycle is turning. The easy gains are behind us, and the phase we are entering is one where volatility increases, where correlations rise, where assets that were supposed to diversify start moving together, and where the risk of something breaking, a major fund, a over-leveraged commodity trader, a sovereign default, a banking stress event, becomes meaningfully higher. The structural convergence happening now is between financial fragility and economic weakness, between over-leveraged markets and under-supported fundamentals, between policy exhaustion and systemic stress. Commodities, because they touch everything, because they are both real and financial, because they reflect both present demand and future expectations, are often the first to signal when that convergence is reaching a critical point. The wild swings we are seeing are not the crisis itself. They are the early tremors, the warning that the ground underneath is less stable than it appeared, that the structures built on assumptions of perpetual liquidity and perpetual growth are now being tested by a reality that is neither liquid nor growing as expected. How this plays out over the coming months will depend on whether the system can absorb the stress, whether forced selling can be contained, whether policymakers can find tools that still work. But the setup is clear, and the setup looks uncomfortably like the periods that preceded the largest wealth destruction events of the past century, not because history repeats exactly, but because the mechanics of leverage, speculation, and systemic fragility always resolve the same way when pushed beyond sustainable limits.